What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about 3 different strategies for how you can make money and profit when the market is crashing. Here is everything you need to know. Let's go. Okay, so the 3 strategies we are going to go into in this video is number 1, inverse ETFs, number 2 is put options, and number 3 is shorting stocks. I'm going to give you a brief explanation and overview so that you can decide which one is going to fit your investment style the best. Now, just a heads up, we're going to go from the least risky investments to the most risky investments. Obviously, there are ways to manage your risk and protect the downside. I'm going to talk about those briefly, but in general, this will probably be the safest that we're going to start with and then the most risky that we're going to finish with. Number 1 is inverse ETF. So an ETF is a group of stocks that track an index and can be traded as one. So an ETF is really nice because you pretty much trade it like a stock, and it's kind of like holding 10 different stocks in one single ticker, and it's one transaction fee. So it gives you instant diversification. A lot of people use these to track major indices like the S&P 500, the NASDAQ, or the Dow Jones. It's really fantastic because it's one trade, it's one commission, and all of a sudden you get into an entire group of companies that can track pretty much any index you can think of, from the major indices all the way down to psychedelics. A brand new psychedelic ETF just launched a couple of months ago called PSYK. It's run by Horizons, and it's a really good ETF. So if you want to learn more about those, definitely check it out. And basically, an inverse ETF is the exact same thing, but the stock and the price moves in the exact opposite direction. So when the ETF goes up, the inverse ETF goes down, and if they're both tracking the NASDAQ and the NASDAQ is crashing, the inverse ETF is going to be doing extremely well. And so if you go into the market and you look at the market and you say tech is crashing right now, I want to get out of tech and I actually want to make money on this crash, then you can go out and you can buy the inverse ETF of the NASDAQ 100, of e-commerce companies, of solar technology, of whatever you want. You can find an inverse ETF that will match your criteria. There's pretty much one for every industry. And so that's what an inverse ETF is. An example of this, or a couple of examples on the major indices. So I have this laid out based on the index that they track. So the index is basically the group of stocks that they're following. So in this case, we're looking at the S&P 500, the NASDAQ, and the Dow Jones. The ETF of those indexes, so the index is a theoretical group of companies. The ETF is what you can actually trade. You can go out in the market and you can buy the ETF. So the ETF of all of these indices is SPY, QQQ, and DIA. So you can actually go out and you can buy those tickers, which will be the ETF of these indices in the market. That's how that works. And then the last section right here is the inverse ETF. So the inverse ETF of the SPY, which is the S&P 500, is SDS. So if you go into your chart and you type in SDS, there will be a ticker that comes up, and that will be the inverse ETF of the S&P 500. The same thing all the way down here, and we're going to look at an example right now. So we are going to look at the NASDAQ. This is QQQ. So this is the NASDAQ ETF. So if you want to buy into the NASDAQ, it's an index. You can't just buy the NASDAQ. You have to buy an ETF that tracks the NASDAQ. You go out. There we go. We made some money. You go out and you buy QQQ, and that will track the NASDAQ for you. And as you can see, it's not doing so well right now. We just kind of crossed through support here that I pointed out on my weekly watch list on Sunday, and we fell through support. It's a pretty bearish sign. Things aren't looking so good. We've got increased volume right now, and it's not looking good for the NASDAQ, and therefore you can see that the NASDAQ ETF isn't doing so well. But if you look at the inverse ETF of the NASDAQ, it's doing extremely well. The inverse ETF is PSQ. As you can see, you can literally just type in PSQ. You can buy this because it's an ETF. It costs $14.74 right now, and it traded as low as $13.29. And you can see over the last 3 days, while the NASDAQ was crashing down, QQQ was crashing down, the PSQ chart has been doing extremely well because it is an inverse ETF, and the inverse ETFs will go up when the indexes and the ETFs go down. But as you can see, obviously, the inverse ETFs will also go down when everything else goes up. So you need to keep that in mind. It's basically the opposite side, and this is probably the safest way to make money when the markets go down, because there's no leverage here. It's not an option, so you're not going crazy on any type of movements here. It's literally moving the same way that the NASDAQ is moving. It's just moving in the opposite direction, and there's no unlimited risk here. The amount that you can lose is $14.74 when you buy in at $14.74. 2%. So if you are new and you're getting into the market and you want to make money when the market goes down, this is probably the best place that you should start. Now, if you're interested in getting a little bit more movement than what you're seeing in these charts and in these ETFs, you can also use something called a leveraged ETF. And that is something that will give you a higher risk to return ratio, but pretty much the exact same principle as what you see here. And so a leveraged ETF is an ETF that moves by 2 times or 3 times the underlying index. So when the NASDAQ moved by 1.5%, you could see that QQQ moved by 1.5%. If you were trading a leveraged ETF, it would amplify that return by 2x or 3x. So in this example here, if the PSQ moves by 2%, then SQQQ will move by 6%. So PSQ is the chart that we just looked at right here. This is the inverse ETF of the NASDAQ, and SQQQ is the leveraged inverse ETF of the NASDAQ. So if you are dead convicted that the market is going to crash as of today, as I make this video, then you could buy the PSQ, and that will give you exposure to making money when the market goes down. Or you could buy the SQQ, and that will give you 3 times the exposure of whatever movement happens in the NASDAQ. And so a leveraged ETF is the exact same thing as a regular ETF. There's a positive side to it and a negative side to it, or an inverse side to it, but it will multiply your returns by 2x or 3x. Now, you need to be very careful with this because they are not meant to be held for long term. The reason they're not meant to be held for the long term is because in order to get those returns, those 2x or 3x returns, they're using options in order to get that return. You're buying it just the exact same way you would be buying a stock, but underlying all of that is a complex, basically, algorithm of options. And as you know, or hopefully as you know, options have time decay. And so the longer you hold them, the less valuable they are. And a leveraged ETF is susceptible to time decay over time, especially as you hold it overnight. That's mostly when it happens. And so you need to be very careful because these leveraged ETFs are meant to be either very short-term holding or day trading. And so that's the goal behind these, but they give you exposure, and they give you leveraged exposure to any of the regular ETFs. They aren't quite as common, but they definitely exist for all of the major indexes that are out there. Now, you need to be very careful when you're using anything with leverage, and the big thing that you need to focus on is your knowledge, because the more you know about how these tools work, the better you'll be able to use them and get a better return for yourself. Now, if you want to learn more about how the tools work and how to use them in combination, then you should definitely consider signing up for my Stock Market Fundamentals course. It is hosted on Skillshare, and it is completely free. When you sign up with the link down below, it'll take you to a 2-week free trial page where you can sign up and you can cancel your subscription at any point. It's about $20 per month, but cancel before the 2 weeks is up, and you get my entire course completely free, as well as access to the entire platform. There's over 9 hours of content. There's 3,000 students that have already gone through the course. There's over 170 reviews for you to take a read through. It's hosted on Skillshare, a very reputable platform, and I promise you it'll be the best free resource that you can find online. And there's a link in the description below. Now, the second way to make money when the stock market is crashing is by purchasing put options. Put options go up when the stock price goes down. And basically, it's the ability to sell the stock at a specific price on a specific date. Now I'm going to walk you through kind of how this works in an example here. So we're going to talk about Apple. I'm just using imaginary numbers for this example to keep it simple. So you go out and you buy Apple put options, and you buy them in a form of a contract. That's how put options are sold. And one contract represents 100 shares. And you pay $1 per share for that basically contract. So it costs you $100. And in that contract, it has a strike price of $10, which means that you are going in and you can sell Apple shares at $10. And it has an expiry 1 month from today. So at the end of this, you just paid $100 for a contract that says you can sell 100 shares of Apple at $10 1 month from today. So that's what you just purchased here, and let's just use that for the example. Now, if the price of Apple shares is $5 after 1 month, you can go out into the market and you can buy 100 shares of Apple for $5. So you have to have some cash on hand, but you go out and you buy them for $5. And then thanks to the contract that you just bought, you can now sell them back to the person that you did that agreement with for $10, and that would be called exercising your contract. And so you bought a contract that said you can sell them at $10. The price fell to $5. You went into the market and bought them at 5, and then you sold them back to that person for $10, and you captured that $5 per share profit. However, you paid $1 per share in that basically upfront fee to buy the contract. And so your total profit was $400 there on an initial purchase of $1, which was basically $100 in total. You did have to have some cash on hand to buy the shares in the market and then go sell them right away. But as long as you had that money, or at least somebody you could borrow that money from, you were able to make $4 per share on this transaction. And that's how put options work, and that's how you could make money on the put options in the event that the market crashes. Now, let's say that the market actually goes up in this example, and basically 1 month from today, Apple's now trading at $15, and there's no point in trying to sell them for $10 when you can go into the market and sell them for $15. And so in that situation, your investment of $1 per share for a contract of 100 shares, your $100 initial investment would basically expire worthless, and you would have lost 100% of your initial investment here. Now, if you do the math on that, you lost $100 if it doesn't work out for you, and you made $400 if it does work out for you. So much higher risk to reward ratio compared to buying the inversed or leveraged ETF. So you need to keep that in mind. And then a couple of things to know with regards to options. The nice thing about options is that you can sell the option at any point before it expires. So for you to convert that option, you actually have to wait till the expiry date. But for you to sell that option in the marketplace, just like any other security, you can do that at any point. It's very easy to do. And so the nice thing here is that if Apple stock started to decline and your options looked like they were going to be more likely to be profitable, it means they would have increased in value to it, probably a substantial degree, and you would have been able to sell them at any point and make money. So you do not have to hold the options all the way until that expiration of 1 month or 2 months, whatever you decide, when you go out into the market and you buy it. Now, you do have to realize that options are much more volatile than the stock or even a traditional ETF, because they basically move and fluctuate, and they have a much higher risk to reward ratio. And so you need to be very careful with that. They're also more complicated. They're sold in contracts which represent 100 units. And then if you're going to exercise them, you need to make sure that you have the cash on hand to actually basically go out and buy those shares. So there's a lot going on when it comes to options. You need to be very careful. And I do have a course on Skillshare that covers all of options. It's like literally the exact same link, and you can do both courses if you'd like. So if you want to learn more about that, definitely check out the description below. And the third option that I want to talk about for making money when the stock market is crashing or when stocks go down is shorting a stock. And the process here is not too complicated, as long as you can just kind of conceptualize it in your head. So first thing you're going to do is you're going to go borrow stock from your bank or from your broker. So I use Questrade. There's a link down below if you guys want to try Questrade. It's really great if you want to short any of the major stocks. And let's say I want to go short on Apple. So I borrow 1 share of Apple from Questrade. That's step number 1. Step number 2 is that I sell that share in the market for, let's call it $100. So now I have $100 and I owe Questrade 1 share of Apple. That's where we stand right now. If the price falls to $50, that's step 3, is hopefully you wait a little period of time and then the price falls just like you were expecting. Step 4 would be to buy that stock back at the lower price. Let's call it $50 for easy math here. So I have $100 cash. I owe Questrade 1 share of Apple. I go into the market and I buy 1 share of Apple for $50. I return it to Questrade. I have now fulfilled my duty with Questrade. I started with 100, it cost me 50, and now I'm left over with $50 worth of profit. And so that is how it would work for shorting a stock. Is you borrow it from the bank, you sell it at the market, the price goes down, you buy it back at a lower price, and then you give that share back to the bank. That's a simplified explanation of how to short a stock. Now, the things that you must know is that you have to put in a stop loss anytime that you short a stock. I am saying this as a rule, as a complete blanket rule. You must do it. And the reason that you must do it is because there is unlimited risk when you short a stock. Meaning that if Apple suddenly went from $100 to $10,000, I still owe Questrade 1 share. And Apple is now trading at $10,000. So for me to settle my debt with Questrade, I now have to go back into the market and buy Apple at $10,000 and give it back to Questrade. And I just lost $9,550 or whatever it is on that trade. And so the unlimited risk comes because a stock, if you buy it, it can go to 0. But if you short it, it could go to $1 million, and you're on the hook for everything in between there. And so you need to be very careful with that, and that's why shorting it is the last option on this list. I highly recommend starting with buying the inverse ETF or a different option like that. Now the process of actually shorting the stock is almost the exact same as it is to buy the stock. You basically go into your broker or your bank or whatever it is, and instead of buying the share to open the transaction, you sell the share to open the transaction, and then to close your position, you buy it back, and that will basically return it to whoever you borrowed it from. So pretty simple process there. It's not super complicated, but there can be unlimited risk on this trade if you don't protect yourself with a stop loss. Now, if you are interested in seeing some of my technical analysis and how I think about stocks on a daily basis, then definitely consider signing up for my Discord chat. That is where I share all of my analysis, my research, and a lot of my trades with the community so that you guys can get a better understanding for how I trade. I'm also trying to build it up as a community of traders to share their insights, share their research, share their due diligence so that everybody can prosper together. If you're interested in joining that, it is $5 per month, and I would love to have you there. But in summary here, these are my final thoughts. Inverse ETFs are usually the best place to start when you're getting into the market and it is crashing and you want to still make money. That's usually the best place to start. Secondly, is the market does not need to go up in order for you to make a profit. The better you can understand the market and the tools that are available to you, the easier it will be for you to make money in the market. So knowledge is your number one resource here, and it's the number one thing that you need to focus on, especially if you're a new trader. And my last point here, the more knowledge you have about how the markets work, the more ways you will find to make money. And this is totally key here. The truth is, the more you know about the markets, the easier it will be for you and the easier it will be to understand where you should be putting your money. Now, if you guys get any value out of this video, please consider hitting that like and subscribe button. I sincerely appreciate it, and I will see you guys in the next video. Good luck trading, good luck investing. Talk to you soon.